All right. Hi, everyone. I hope all of you are staying safe and staying healthy. So, today I'm going to review what I've learned from international finance from semester 9 and sorry, session 9 until right now. So, this is my mind map. It's just a typical mind map. So, we have six topics to discuss. So, first up, we have types of exposure, which from my international finance class, I learned that there's three types of exposure. The first one we have is the transaction exposure, which is the level of uncertainty businesses involved in international trade face. Specifically, it is the risk that currency exchange rates will fluctuate after a firm has already undertaken a financial obligation. Next one we have is the economic exposure. So this is a type of foreign exchange exposure caused by the effect of unexpected currency fluctuations on a company's future cash flows, foreign investments, and earnings. Economic exposure, or better known as operating exposure, can have a substantial impact on a company's market value since it has far-reaching effects and is long-term in nature. And finally, the last exposure that we have is the translation exposure, or also known as the translation risk. This is a risk that the company's equities, assets, liabilities, or income will change in value as a result of exchange rate changes. This occurs when a firm denominates a portion of its equities, assets, and liabilities or income in a foreign currency. So the first one we've discussed. The next one that we're gonna discuss is the types of derivatives. I'm sorry. So we have three types of derivatives. First one we have is the speculation, in which we refers to the act of conducting a financial transaction that have substantial risk of losing value, but also holds the expectation of a significant gain. So we have to be kind of speculate on whether for example, the today's US dollar to Indonesian rupiah is, let's say, for example, this is an example, yeah, 14,500, and we need to speculate whether it will increase or decrease on the next day, on the next currency. So that's the first one on speculation. Next one we have is arbitrage. Now, this is a simultaneous purchase and sale of the same asset in different markets in order to profit from tiny differences in the asset's listed price. It exploits short-lived variations in the price of identical or similar financial instruments in different markets or in different forms. Last one we have is the hedging. Hedging attempts to eliminate the volatility associated with the price of an asset by taking offsetting positions, that is, contrary to positions the investor currently has. So the second topic we have discussed. Now let's move on to the now let's talk about forward contract versus future contract. So here are the differences. Forward contract Forward contract is a private and customizable agreement that settles at the end of agreement and is traded over the counter. An example of forward contracts, this can help producers and users of agricultural products against hedges against a change in the price of an underlying asset of commodity. Now that's the forward contract. Whereas on the other hand, the future contract has standardized terms and is traded on an exchange where prices are settled on a daily basis until the end of the contract. Future contracts are used by two categories of market participants, which are hedgers and speculators. Producers or purchasers of an underlying asset hedge or guaranteed the price at which the commodity is sold or purchased, while portfolio managers and traders may also make a bet on the price movements of an underlying asset using futures. So that's the difference between forward and future contract. Now let's move on to the call versus put options. I think I forgot to add options in it. So here are the differences. Call option. This option is a derivative contract between two parties. The buyer of the call option earns a right. It is not an obligation to exercise his or her option to buy a particular asset from the call option seller for a stipulated period of time. Whereas on the other hand, put options, this gives holder of the option the right, but not the obligation to sell specified amount of an underlying security at a specified price within a specified time frame. Put put options are also available on wide range. Sorry, put options are put options are available on the wide range of assets, including stocks, indexes, commodities, and currencies. Put option prices are impacted. Now, this can be impacted by the change in the price of the underlying asset, the option strike price, time decay, interest rates, and volatility. So, I've already discussed on the call versus put options. So right now, let's talk about the types of swaps that we found. So the first one we have is forex forex swap. Now, foreign currency swap, also known as FX swap, which is forex, it's an exchange to it's an agreement to exchange currency between two foreign parties. The agreement consists of swapping principal and interest payments on a loan made in one currency for principal and interest payments for a loan of equal value in another currency. The next one we have is the interest rate swaps. Now, these are forward contracts where one stream of future interest payments is exchanged for another based on a specified principal amount. Interest rate swaps can be fixed or floating rate in order to reduce or increase exposure to the fluctuations in interest rates. Next one we have is the currency swap. This is a transaction in which two parties is exchange an equivalent amount of money with each other but in different currencies. The parties are essentially loaning each other money and will repay the amounts at a specified date and exchange rate. So, and finally, we have the interest rate and currency swap, which is basically the combination of interest rate and currency. So that's the types of swaps. And lastly, I'm going to talk about the types of options that we have. So the first one we have is options on a single stock. All right, next one we have is the stock index option. So this refers to an option with the underlying asset being the value or price of an index of stocks. For example, is the S&P 100. Next one we have is the interest rate options, which are financial derivatives that allow investors to hedge or speculate on the directional moves in interest rates. A call, a call option allows investors to profit when rates rises, and put options allow investors to profit when rates fall. And finally, we have is the foreign currency options, which this option is a contract giving the option purchaser, or also known as the buyer, the right, but not the obligation, to buy or sell a fixed amount of foreign exchange at a fixed price per unit for a specified time period. So before I end this session, I'm going to share with you this. Wait. Right, okay. So as we can see, these are the several factors on the premium options which can be affect on the call options or the put options. As you can see, the S, S is S on the effect of on call is positives, the positive impact, whereas on the put it will be on the negative side. The alpha represents on now the alpha, both call and put have a positive impact. The X is the call is negative and well the put is positive. The time, I don't know if I'm correct, time is the effect on call can be positive, but however on put it can be either positive or negative. Next up we have the D, which is the D on the effect on call, which is negative, have a negative impact, while on the put have a positive impact. Finally, the small r, which I forgot to add on the factors, which the effect on call is positive, and whereas on the put options it will be negative. So that's it from my mind map. So I apologize if there's any mistake, and thank you for watching, and Thank you and goodbye. Assalamualaikum